mean, I believe $6,000 or $7,000 gold. I believe $200,000 Bitcoin, but I can't say when. And if I did tell you when, you shouldn't trust me because nobody really knows exactly when.
Right.
But I think we can kind of look at it and handicap the odds. And the odds are it's coming. We just don't know when. For people who weren't invested in these assets and watched them take off, and I had friends saying, "Oh God, Bitcoin at 125, I missed it," or "Gold at 5,000, I missed it." And of course, the ironic thing is, I call them now and say, "Hey, you know what? You got an opportunity here. Gold's down substantially. Bitcoin's down 50%. Why don't you come after it?" And they're kind of, "No, I don't know.
I don't want to catch a falling knife." Yeah, exactly.
Yeah, I don't want to catch a falling knife. Where's the bottom? And look, I don't know where the bottom is. Nobody does. I mean, you can't. But I kind of evaluate risk and reward, and I look for asymmetry. And I'm very, very convinced that they're asymmetrically. There's a lot more upside in all three of these things than there is downside.
What if I told you that we are on the threshold of a significant financial turning point, according to one of the most ignored voices in macro investing today? Lawrence Lepard is that voice, and his message is straightforward but impactful. The current system is under tremendous strain, and most people are unaware of the implications for Bitcoin, gold, and silver. While the headlines stay mixed and sentiment feels uncertain, Lepard argues that this is exactly the kind of environment where the biggest opportunities are born, not when everything feels safe, but when everything feels uncomfortable. And here's the key question. What if the market weakness we're seeing right now isn't the end of the story, but actually the setup for the next major move? Let's explore the latest insights from Lawrence Lepard's recent interview.
Yeah, I mean, it's the market's traditionally always weak around this time. And you got to remember, everybody's going to have to write a tax check in a couple of weeks, and so that always tends to have some people selling stocks because they've got to raise cash to pay their tax bill in the United States anyway. So Look, to me, this is just part of the up-down cycle in this area. And it actually represents kind of an opportunity, for people who weren't invested in these assets and watched them take off. And I had friends saying, "Oh God, Bitcoin at 125, I missed it," or "Gold at 5,000, I missed it." And of course, the ironic thing is, I call them now and say, "Hey, you know what? You got an opportunity here. Gold's down substantially. Bitcoin's down 50%. Why don't you come after it?" And they're kind of, "No, I don't know.
I don't want to catch a falling knife." Yeah, exactly.
Yeah, I don't want to catch a falling knife. Where's the bottom? And look, I don't know where the bottom is. Nobody does. I mean, you can't. But I kind of evaluate risk and reward, and I look for asymmetry. And I'm very, very convinced that they're asymmetrically. There's a lot more upside in all three of these things than there is downside. I mean, could they all go down another? They could all go down another 10% tomorrow. They could all go down probably 30% in a correlation to one event. But, they also have the potential to double or triple when Kevin Warsh becomes, Fed chairman in a little over a month and a half. And, I don't think he got that job by, saying he's going to do hawkish stuff. I mean, I think my sense, and this is just a guess, I have no knowledge, no insider knowledge whatsoever, but knowing how things work down there, my sense is they're crafting something in their back pocket that's going to look like a big print, that's going to involve a lot of money creation. Now, maybe it'll be done by the banks through some special lending program where they'll let the banks, buy, they'll lend money to the banks at a lower rate in order to buy bonds specifically and hold them for a fixed period of time. I mean, they'll have a new term for it, right? I mean, the most recent one is not QE, right? It's reserve.
Right. Whatever you call it, it's not QE.
Yeah. But you and I both, I mean, when you look through it, at the end of the day, they'll be putting more money into the system because mathematically they have to, Adam. That's the thing. I mean, I just, look, I'm not smart enough to know what all the moves are going to be, but I can look at the math pretty clearly and I can see the problem. And, how does this get resolved? I mean, there is another choice. They could let everything collapse. They could let it be a 1929. But do you really think that at the end of the day, faced with that, they're going to do it and they're not going to print? I mean, I don't.
Would any sitting politician or central planner let that happen on their watch? No.
No, they just can't. So it's to me, it's an interesting trade because you can be very highly confident you're right, but you got to be patient. I don't know if the low is in yet. If it's not in, we're close to it. Let me put it that way. And I certainly from a sentiment point of view, particularly, well, in both assets, really. I mean, Bitcoin hit 126 in October, right? And it's been as low as 60 on a spike, and it's mid-high 60s now. So, and I got to tell you, the sentiment's just dreadful, right? I mean, everybody's cranky, and there's a lot of negative sentiment in Bitcoin land. The gold people are it's a much shorter experience because, gold was roaring into the first part of the year and now is corrected. Silver even more so. And I really think all three of them, what happened here, Adams, they all just got ahead of themselves. I think, as you know, I manage a fund. I have a long-term time window. I measure it in years and really 5-year time frames. And so I'm very, very comfortable that I'm right about the thesis, over a longer time frame. On the shorter time frame, my best answer is if we're not at the low and they haven't turned around, we're close. And I'm not sure if I didn't have any of them, I certainly wouldn't wait to buy them. But there's always what I call the correlation of one event, which is the March of 2020 or the September of 2008 kind of situation where all markets seize up and everybody, there's a global margin call and a demand for cash. And guess what? Everything gets sold. And in that event, they're all going down. And, Bitcoin could go to 50 or 60. I doubt it will, but it could. Gold could easily trace back into the 3,800 range. Bitcoin or silver broke out at 50. I don't think it's going below 50 again. It's in the mid 70s now. I mean, I think it might have touched the 60s briefly, but and it could go back there in one of these correlation of one events. Now, so then you get into what are the odds we're going to have one of those? And I don't know. They're not zero because when you look at all that's going on in the world, some of the bad stuff, the war, etc. If really stupid things continue to happen, and some stupid things have already happened, but it looks like we're walking back from those, it could get worse. And the book outlines, and my thesis has always been, all of this correlation of one event would do is it would bring the necessary big print forward and make it faster and bigger. And we already, I wrote the book, I titled it The Big Print. We don't have a big print yet. We have, what Lynn calls a gradual print, or what I call a little print, which is $40 billion a month times 12 months is 480. That's not trillions like the last two were, but it's not trivial. And Ascent is also using the Treasury to effectively kind of not print, but manage the Treasury market because he's selling bills to buy the long bonds. And so that's kind of an Operation Twist to keep the 10-year from blowing out. So I don't know. My base case right now is that, and I don't want to venture too much into political events, but I think when Lindsey Graham says, we should wrap the war up, I think the memo has gone out that I think finally they've convinced, they've gotten themselves convinced, hopefully they have, that ground troops would be an unmitigated disaster. And that as bad as this war has gone for us in a number of different respects, doubling down on it would really be stupid. And so what I'm hoping occurs is that we back away from that. And I don't think Iran really has an interest in totally croaking the world economy. And I think Iran actually likes getting revenue from their oil sales. It helps them.
Well, it's pretty much the only way they bring in revenue.
Right. And so my sense is that, what we're going to maybe trend toward is kind of a messy negotiated thing where Israel agrees to stop lobbing missiles and they agree to stop lobbing missiles. And, U.S. and Israeli boats can't go through the strait, but other boats can, and they pay a toll. And, we kind of limp forward. But, all the while, meanwhile, the stock market is leaking and, the private credit thing is real and larger than everyone thought at first. And so, at some point in time, something big could break. And if it does, then you got your correlation of one event. So I guess what I say to people is, if you're in these assets, you just have to realize how asymmetric they are, and you have to be prepared to have a drawdown. But I think most of the drawdown in all three of them has occurred. The power law supports kind of a lower end boundary of 50, 55, 60K for Bitcoin. We're there. We're at 66. So you got 10% downside. Silver broke out at 50. Sometimes when a market has a big market that's pressed for a number of years has a breakout, it'll go back and retest that number. And so it's at 70. Maybe it could go to 50 briefly. Gold could clearly come back in, but I think everybody's got to have their eye on the longer term prize, which is, the $39 trillion of debt, deficits running at 2 trillion. And I had a chart, I just looked at a chart that showed that, if things get worse this year, they're going to clearly be much more than 2 because the war is expensive. There's no way they're going to get by without printing the money. It's just math. So So, and when that becomes apparent, then these things are going to really catch wind in their sails again. And I think, there are a lot of people calling for $200 silver. I believe it. I mean, I believe $6,000 or $7,000 gold. I believe $200,000 Bitcoin, but I can't say when. And if I did tell you when, you shouldn't trust me, because nobody really knows exactly when.
Right.
But I think we can kind of look at it and handicap the odds. And the odds are it's coming. We just don't know when.
However, Lawrence Lepard's perspective on silver is among the most intriguing aspects of his theory. Lepard contends that silver may be the more underappreciated possibility at this time, even though gold typically receives the most attention. The explanation is straightforward. Silver serves two purposes. It is an important industrial metal used in solar panels, electronics, and contemporary technology, in addition to being a store of value like gold. And demand is rising fast. Countries like China are already using massive amounts of silver, and as clean energy and tech production grow, that demand is expected to increase even more. Lepard also draws attention to something that most investors overlook. The recent change in the price of silver has not yet been completely reflected in silver mining equities. Despite the fact that silver has risen from the low $30 range to roughly $75, many mining companies have not yet experienced the same degree of profits.
And sentiment got incredibly lopsided. I mean, bullish sentiment on silver, gold miners, all of us, 100%. Interestingly, I get Hulbert's Sentiment Digest sent to me every day. It's a service I pay for. Right now, the sentiment on gold prices is negative, which is pretty rare. I mean, it kind of generally ranges between 0 and 100 positive, and right now it's running like 17% negative. So,
wow. That's impressive that gold's still at 4,700.
Well, that's my point, right? I mean, it's kind of like we've shaken out the tourists, and people are pretty scared. And I talk to, the best analysts on gold, or the people who most people follow on gold, the gold mining analysts in Toronto. And a lot of them, they're starting to build their models with lower numbers again. And that just tells you that they're thinking, these numbers aren't going to hold. And that, I take the other side of that bet. And particularly, we're going to talk about opportunities maybe later in this conversation.
We will.
The silver miners are just, it's unbelievable. I mean, silver went up a lot, right? It went from low 30s at the beginning of last year to 120 briefly, and it's 70 something now. And most of these companies, they spend about $25 to pull an ounce out of the ground. So in the low 30s, they're making $10 an ounce. Well, at 70, suddenly they're making $50 an ounce, and
right.
That's a 5x increase. And yet I can assure you that most silver stocks have not gone up 5x.
Right.
So the profits have gone up 5x. The stocks haven't gone up 5x. Why? Because people don't think the silver price is going to last.
Right. They don't believe it yet.
I think it's a bubble, right?
Yeah. That's to have to deal with the higher oil prices.
Yeah.
It's trying to keep a lid on their currencies. So my question is this short-term stuff that's sort of related to the oil price shock and stuff related to the war that should revert back afterwards, or is this a new trend?
No, I really do think it's short-term, but it's interesting. Russia has sold some gold, but that's because, they're getting paid in yuan for all the oil they sell to China, and they can only use so much yuan to buy Chinese goods with. Now, maybe they convert some into gold over there, and they're not reporting it, but they've been selling gold because they need rubles in order to, to pay their salaries of, their military and so forth. So, yeah, the other thing I've heard, and we talked to my partner and I were talking to a guy from Dubai recently. I mean, so you're in the Middle East, you own a bunch of gold, and you decide you want to get out of there for all the obvious reasons. And gold is effectively cash. Well, what do? You can't wire transfer your gold from the Middle East to somewhere else, but you can sell it, and the cash you get, you can wire that out, or you can put it into Bitcoin and move it on the blockchain. So, so there've been some selling pressures and things like that. But I think the underlying trend in money that can't be printed, gold, silver, Bitcoin, is up and to the right. I mean, I strongly believe that. But I just think we're in one of those periods where we're having a natural check back, and it's bull markets try and throw off as many riders as possible. I think at the end of the day, the paper market is collapsing, and it's going to come down to being a physical market, and you can't print silver, and so the price discovery is just going to lead to higher prices. I mean, we've already seen a real gap between the prices in the West, the U.S., and the prices in China, and it's getting used heavily in China. That's the thing. I mean, the thing about silver, it's really neat the way it's kind of a dual use metal. I mean, one, it's got this monetary property of being scarce and being kind of a cheaper form of sound money than gold, but it also gets used in solar particularly. And, the current estimates are that, China in a few years will absorb 50% of the annual silver supply. And we also know from all this, looking at the statistics, that they've been running a silver deficit, for 3-4 years at least, in terms of we've been, more silver is being used in industry than we're mining. And so, eventually that's got to give. And I think that's what initially broke us out of the $50 price cap, which had been in place for a long time, well, really forever. We'd never been above 50.
And had barely ever been at it too, just
yeah, right. We were only at it briefly. We were at it with the Hunts, and then we were at it in 2011. And so, you've got an enormously long base of silver prices under 50. We broke through it. And typically anyone who studies commodities and commodity trading patterns knows that, when you break through a 50-year ceiling, you don't just go up 50%, which is what we are now. We're at 75, up 50% from the 50s. You go up multiples of the ceiling you broke through. So and the silver to gold ratio has been coming down, and it could go down a lot further. For much of history, the silver to gold ratio is about 15%. So, 15x. So, and that, by the way, is geologically what's going on in the world. We mine about 15 ounces of silver for every 1 ounce of gold. And so, silver can easily be, and has in the past been, 3% of the price of gold. So if gold's at 5,000, silver should be at 150. We're at 75, and I think gold's going to 6,000 or 7,000. So 3% of that is, 180. And there were on peaks, silver's been 6% the price of gold. That's closer to the 15 ratio. So 6 times, say $7,000 gold, that's $400 silver.
Right. So it's getting
all those numbers are a long ways away. And here's the thing, here's the investment implication of that I'm just so excited about with my fund, and I want to tell people to focus on, is these silver miners just still do not reflect that. Go to Tavi Costa's thread on Twitter and look at the silver miner to the silver price chart. You might have to scroll back a few days or weeks to find it, but it's there. And what you'll see is that the miners just have not responded. And so these miners are going to and the miners, I know what's going on. People who own the mining stocks are thinking, yeah, it broke out above 50, but it's coming back to 50. And yeah, they'll make money, but not that much. Well, I disagree. It's going to 150 or 200. And at that point, they're going to make so much money, it's going to be amazing. And so these stocks have a long way to go to catch up.
Lawrence Lepard essentially explains that, in his opinion, the recent decline in markets such as gold, silver, and Bitcoin is more of a short-term response to global uncertainties such as oil shocks, tensions associated to conflict, and transient liquidity pressure. He makes the argument that anomalous flows such as nations or investors selling gold to transfer funds or adapt to local circumstances do not indicate a shift in the long-term trend. Rather, he thinks the overall picture remains unchanged. Non-printable assets like gold, silver, and Bitcoin are steadily increasing over time. According to Lepard, what we are currently witnessing is a typical cool-off period following significant movements, during which markets shake out weak or sentimental investors. He believes that the severe negativity in sentiment is actually a good sign for long-term investors because it frequently occurs close to significant bottoms or prior to the next significant upward trend. Additionally, he draws attention to a significant discrepancy. Silver and silver mining stocks do not accurately reflect the actual rise in demand or profitability. He contends that opportunity is precisely created by this doubt. Miners may finally catch up dramatically if silver maintains its long-term breakout, perhaps yielding rewards that are out of proportion to the commodity itself. Additionally, he links this to a more comprehensive macro perspective, which holds that governments and central banks would probably keep printing money in times of crisis, further bolstering hard assets.